Hello and welcome to the Deduction, a Tax Foundation podcast. I'm your host, Kyle Hulehan, and we are back with another episode with my co-host, Erica York. But today we are joined by Daniel Bunn, President and CEO of Tax Foundation, and Garrett Watson, Director of Policy Analysis. So this is our 100th episode of the Deduction. It's been an incredible journey. We're really thankful for all of you to listen and follow along. And to mark this 100th episode, we're diving into the biggest stories in tax, the ones that are shaping policy. And we just want to kind of start out by, first off, I want to introduce and bring everybody on. How's everybody doing today?
Doing okay, Kyle.
Good,
Yeah,
good.
everybody's doing good. Yeah,
Living the dream.
ready to talk about the biggest stories in tax, I'm sure. And so I think we want to start out by going worldwide. Global tax deal. We've talked about this before. We have had a number of episodes on the global tax deal, and that's why we have Daniel Bunn here to talk about this a little bit. So could you maybe just give us some of the highlights or break down some of what's happened in the global tax deal? Is the global tax deal dead? What's going on? I think you got it from here.
Yeah, thanks, Kyle. This is one of the big stories that we've been watching over the last several years. We were chatting beforehand. I think this podcast has been running for almost 5 years now. So exciting to see where we are here at the 100th episode. But the global tax deal really came to be over the course of, I would say, 2018 to 2022, after the U.S. reformed its tax code in 2017 and brought in some new kind of interesting international rules that other countries looked at and they thought, oh, there might be a template here that the rest of the world could follow along. So there was a lot of negotiation at the international level on what these model rules could look like across the globe. And towards the end of the Trump administration, there were some ideas that hadn't been fully brought into agreement, but plenty of proposals that countries were looking at. And then during the Biden administration, there was a bit of a switch in tactic, where prior to the Biden administration, the U.S. government, the first Trump administration, was looking at this as something the rest of the world would do, and the U.S. wouldn't have to change anything additional. The Biden administration said, well, we would like for these rules to be tougher than what was conceived before President Biden came into office, and we would like them to pressure the U.S. into changing its rules. So where we are now, a lot of countries have adopted these rules. There's 3 different parts to them. They're interlocking rules. There's some very extraterritorial parts of these rules that are really controversial and have raised a lot of concerns among experts and policymakers, not just in the U.S., but around the world. But countries in Europe, all the European Union member states are supposed to be bringing these rules in. There are several countries that have gotten a little bit of leeway because they are not home to very many large multinationals. But the United Kingdom has brought in these rules. Japan, South Korea, and several other jurisdictions are changing their approach to corporate tax because of the global tax deal. And then we saw, just a few months ago now, the Trump administration came in and said, well, actually, we want to pivot back to where these rules were prior to the current state, and actually looked at the rules and said, well, we don't want these rules to apply within the United States. Now, it's not really clear what that means. It could mean that this whole package dies at some point. It could mean that there's a rolling back of the most offensive parts of these rules. But this is a dramatic shift in that this is the first time you've ever had a set of rules that are kind of globally agreed, where lots of countries are implementing the same package. And that's a new thing, and that has created a lot of both momentum for different corporate tax policy changes that raise corporate taxes. That's not something that we at Tax Foundation are all that enamored by. And also, it's created pressure in opposition to these rules, particularly among U.S. policymakers who do not want these global rules to impinge on their authority to set U.S. policy, especially for incentives like research and development, where the U.S. could say, well, we're providing this tax credit, and another country say, well, we're actually going to claw that credit back through these minimum tax rules. But it's been a huge change in the way conversations around corporate tax and international corporate tax works. And whether this dies or not, I think the direction of policy has shifted because of the negotiations that we've seen over the last several years.
I'd be curious from the federal side, what is sort of the perspective, with the US perspective, maybe if you could give us a little bit more of that on the global tax deal of like why this wouldn't work for us or why this might be a bad idea for us or what could be good about it maybe.
So I think one major angle, of course, here beyond sort of what the exact U.S. position is on this long term is the specter that disagreement over global tax policy feeds into the ongoing and ever enlarging trade war. Of course, we are going to see, Europe and other OECD countries move forward full speed ahead on aspects of the global deal here that will potentially increase tax liabilities for U.S. multinationals, and that is being seen increasingly both by members of Congress who are skeptical and by the administration as an affront to the U.S. Tax base, and they may retaliate either via reciprocal tariffs or if, for example, we start seeing an increasing number of digital service taxes, depending on what happens with Pillar 1, that could also lead to additional tariffs and retaliation. And so it sort of feeds on itself where it ends up being a lose-lose both for countries abroad and for the United States. And so that's one aspect. The other, of course, is I think uncertainty about the long-term, compliance of the U.S. with respect to GILTI and what we're doing with our international provisions. There's some, of course, discussion about where the rates should be with GILTI and with the other components like the FDII deduction that provides an incentive for bringing intangibles into the U.S. And so I think that's another question mark that's been lower priority in the broader tax discussion this year, but is important for multinationals who are looking to determine where they want to be in their supply chains and digital investments long term.
Yeah, and I think one other element of this is, the perspective that countries have on corporate taxes generally, but particularly in the cross-border space. There's all sorts of studies and arguments and clear activity that shows that companies will try to, when the opportunity arises, to avoid taxation in their home jurisdiction or minimize their taxation generally. And most of this is done by legal means. But countries, including the U.S., have been concerned about that and brought in different rules to pare back or address some of those avoidance questions. Where the U.S. policymakers are looking at the global tax deal, they say, well, yes, we also care about tax avoidance, and we have rules that deal with that. We think these rules go much further than necessary, and the compliance cost is so high that it's probably not worth whatever revenue you get out of it. And actually, it's worse for the U.S. Treasury. When countries abroad raise their taxes on U.S. companies, we provide a foreign tax credit for those payments abroad. So it's a net drain on U.S. resources when other countries are raising their taxes. So both U.S. shareholders or shareholders of U.S. companies are worse off, and the U.S. Treasury is worse off. So that has shaped a lot of the U.S. side thinking of these policies.
I think one other element of this that's interesting is looking at like how the Biden administration spoke about the global tax deal and provided, support for it at the administrative level and in the administration's proposals. Then if you look at what, the democratically controlled Congress actually did, they didn't take those up. They didn't, make the changes that Biden suggested in his budget that were part of, the Build Back Better proposals. Instead, they kind of just left things as they are, which I think shows that at least among Congress, there's more skepticism, or there's at least not enough support to get the votes necessary to move closer towards what the OECD is doing. And I think that leads us back into domestic tax policy and looking at some of the biggest changes that have happened domestically were under the Biden administration and the Inflation Reduction Act, which was signed into law in 2022. That made changes on the policy side, and it also made changes on like the tax administration side with increased funding to the IRS. So Garrett and then Daniel too. How have those changes been playing out?
So we've had a few years now since 2022 when the Inflation Reduction Act was passed. And of course, it was the largest set of tax changes since the 2017 tax law that brought about additional work both for the IRS and for businesses who saw some major changes to their their tax potential tax liability and to just how they calculate their taxes, right? One big one, of course, from the corporate side was the introduction of a couple of novel taxes that were part of a broader tax debate in the years leading up to it. So they weren't entirely surprised, but they did require a lot of evaluation, both by the IRS and on the part of companies, to understand how it will affect them and to comply with it. And that was two of which were the new minimum tax on book income for corporations. So effectively a new tax base, book income with some, actually many exceptions carved into it. So a fairly complicated tax, a new minimum tax imposed, and then a new excise tax of 1% applied to certain stock repurchases for large corporations, both of which are fairly novel under U.S. law and took a while, particularly the minimum tax for the IRS and Treasury to develop regulations and guidance for corporations to comply with. We're just starting to see now in the last 18 months more detailed guidance applying that minimum tax structure to particular situations, particularly firms in, say, finance, insurance, places where book tax can get fairly complicated. And you're starting to see corporations, of course, trying to comply with this, both to understand if they fall into the tax and if they do they owe additional tax liability. Generally speaking, that was an interesting situation in that I think it's fair to say many tax economists, tax lawyers, scholars across the ideological spectrum were generally found that tax design lacking. Folks who supported it were seeing it as a second best solution to alternatives like raising the corporate rate. But there's been widespread skepticism about how this tax would impact not just incentives to invest in the economic impacts that are often talked about in tax debates, but also the complexity and how it may erode financial accounting standards and the usefulness of financial accounting because firms are going to try to manipulate that potentially to reduce their tax exposure. But this is really much a real-time experiment. We're still seeing, of course, the early stages of this. It may take several more years to see a couple things. One is, are the skeptics right about erosion of the usefulness of financial accounting given this new tax? And does this tax actually work? If we remember, a big motivation for this was this idea that corporations were earning accounting profits, right, financial profits to their shareholders, but we're not paying any tax because the tax code, in many cases rightly, provides various deductions and credits that may reduce their tax to zero. But the important caveat is this very tax provides a lot of carve-outs to companies to preserve benefits policymakers like the R&D tax credit, like the green energy credits provided by the IRA. So that might mean that the tax ultimately doesn't actually collect as much revenue as expected. It may not be that effective in its goal. So that's one we're going to have to continue to watch long term. And of course, the other major item, the major legacy of the IRA, we have to mention, of course, is that nearly $1 trillion in green energy credits over 10 years that really was meant to be used to encourage decarbonization, right? A move both from the electrical grid to our transportation systems toward a green energy future. But there's been, of course, a sharp political and policy split on the effectiveness of these credits, whether or not it makes sense to have them in the tax code. And we'll see this year if Republicans pare them back. That's going to be a major question about the long-term legacy of this law.
That was an interesting tension of the IRA. On the one hand, we want to, ensure that corporations are paying taxes every year, even if, maybe they're not actually profitable in terms of taxes. And then we're also going to provide all of these corporate tax credits. So we have to make sure they are not clawed back by the CAMT, the alternative minimum tax. And then, of course, during the debate, we all watched these issues pop up. Well, you don't want to claw back bonus depreciation. Well, we don't want to claw back these tax credits. We don't want to claw back these provisions. So you ended up with a really tortured alternative minimum tax that will be worth watching. And another tension, I don't know who wants to chat about it, but there was also increased funding for IRS administration. So at the same time, we're making the tax code more complicated and harder to enforce. We're also providing a bunch of money to the IRS for enforcement. How has that funding for the IRS been playing out too?
Yeah, so I think there's an element in what you were just saying, Erica, that we talk about a lot. And the IRS funding is it's a very politically charged debate. But we at Tax Foundation, we love tax simplification. And we would love to be able to say, well, actually, the IRS doesn't need as many resources to enforce a simpler tax code. But you hit the nail on the head with the tension in the Inflation Reduction Act, where Congress was actively increasing the complexity of the tax code while saying, well, we need to invest in taxpayer services. Now, I think there were some elements of the last couple of tax years, tax seasons, where it seemed that customer service was improved, and there were some elements of the tax filing season that were better. But it's really challenging to really see how this is a long-term sustainable thing where Congress makes the tax code more complicated. And then there's a massive political divide over funding the IRS. And it's possible, I think we'll talk in a minute about what Congress might be looking at this year. But there's some things on the table currently that Republicans are looking at that would also complicate the tax code. And Garrett, I want to come back to a point that you were making about second best solutions. And Erica, you used the word tortured. I would say I would combine those two and say this is all tortured second best solutions. The alternative minimum tax uses financial standards that have a very different purpose than tax rules, and we've written about this a lot. And the Inflation Reduction Act credit for those who are interested in leaning policy towards a less carbon intensive economy. This is also, again, a tortured second best outcome. And then, similarly with the way the stock buyback excise tax has fit into this, again, like it's not necessarily the first option that you should be looking at if you want to treat dividends and buybacks similarly. Now, the fun thing is, and I'll make a plug for something we're going to do in a couple of weeks. We're going to be digging into the credits and accounting in the tax code, and also some other policy ideas at an event we have coming up on April 10th. You can find that on our website. But one of the big takeaways for me over the past 5 years, and the Inflation Reduction Act captured a lot of this, is that Congress is interested in doing things that have really uncertain budgetary and economic outcomes. And that doesn't make for good tax policy, and it certainly doesn't make for good fiscal and economic policy over the long term. And so one of the things that we're hoping to bring up consistently over the course of these debates is say policy, Congress shouldn't be getting all creative with the tax code. That's not usually the thing you want to see. It's similar with accounting. You don't want an accountant who wants their spreadsheets to be a work of art, especially not on the impressionist side of things. You want people to have simple and straightforward rules that they're following. And same thing with tax code design. And that's not something that Congress seems to have been interested in over the last 5 or 6 years.
And Daniel, real quick, you're touching on something that I kind of want to pull back for maybe the more general audience like myself, is you're talking a lot about second best choices.
Yeah.
We're not making the best choices and I wonder, just, as a non-economist on this podcast, is it a fundamental misunderstanding of tax policy, or is it politics? Is it that green energy tax credits in this case are, while I think can be a good thing, but also a political move, or, they just don't understand what will work best?
So it's a combination of the two. So with the alternative minimum tax, I think the efforts behind that policy reflect a fundamental misunderstanding of how the tax code works for businesses. But the momentum behind that idea that was, generally baseless as far as tax policy was concerned, met with an effort to raise corporate taxes somehow, and the politics leaning into an increase in corporate taxes, kind of paired up with this misunderstanding of how the corporate tax might work, led to the result that we saw. Now, I think with the Inflation Reduction Act credits, there are a lot of good arguments for the design that Congress went with there. But again, the first best solution would have been something more along the lines of a broad-based carbon tax, or something. I think the Biden administration and Congress aimed for more neutral technology, neutral credits, but there's still a lot of distortions even with that purpose. But if you want to spur investment, things like bonus depreciation are much better and much more neutral than picking and choosing which industries or sectors get a special credit.
And so I'm gonna slide this into a similar conversation here on tax incentives, which is with the Chips and Science Act. We were trying to bring semiconductor manufacturing back to the U.S. And so I'm pitching this to you, Garrett. Like, have these tax credits actually delivered on their promises?
So on the Chips and Science Act, I think the major headline coming out of particularly the late Biden administration, and we saw in the transition, looking at the president's legacy and sort of the state of the U.S. economy. There's a few interesting trends that are going on here I think are important to dissect. One is, of course, we did see, the CHIPS Act was passed at a time when there was a pretty, robust economic recovery. A lot of it just coming from a natural recovery of normalization after the pandemic. And as part of that, though, we have seen there's been a debate about, the drivers of an increase in certain forms of tangible investment, most specifically an increase in factory building in the United States, well above trend. It's actually one of the key indicators that advocates of this more aggressive industrial policy or, interventionist policy to more create targeted incentives point to, because it does, it's inconsistent with this story where you may see, some building factories that, of course, is a prerequisite for increased tangible industrial production in the United States. And so that's one metric. But it is also fair to say that that is far from the only point of the story, because when you look at broad measures of industrial output or other broader measures, the result is a bit more muted. We have come back to trend, but it hasn't been significantly above trend. And so that leads to the tricky and I think key question here from a policy perspective, and something we point to a lot, which is, a key measure of whether or not this industrial policy, this targeted incentive to re-onshore, increase our manufacturing base for semiconductors or other things, is, are we actually increasing the amount of output there, or are we merely, shifting the composition of output? That's one key question, right? Because to the extent that we are merely shifting the composition of output towards, say, factories and away from other things, some folks may say that that is, part of the goal, to increase, the production of chips at the expense of other things. But that's still an important trade-off that people, voters, policymakers should know about, right? That there may be less production of other things in the U.S. or creation of services in order to create these factories, in order to create this activity. So that's really important. The other, of course, important thing we have to control for, that's very hard to do, is the counterfactual of how much of this activity would have happened anyway. We see this a lot with very specific investments in particular localities and in the U.S. of plans that firms may have already had, and they latch on to certain incentives while they're doing it. But of course, that is not part of the ultimate goal, which is increased production over what would have already have happened. So I think the jury's still very much out. It is going to require another, many years, potentially decades, to really say whether or not this is working well. And of course, the counterfactual is always the one that we don't know about, right? Which is, what are the innovations and investments that would have been made if the government had made another decision? And that's why broad-based policy is typically better, right? Because markets often are better at this type of resource allocation than targeted investment. But it's worth checking in on, because it's not just the Biden administration or folks who passed the CHIPS Act who care about this. This is very much still a live debate in the current discussion about our relationship with China. To what extent should we be relying on interdependent supply chains or using industrial policy to onshore? So it has much bigger implications for U.S. policy moving forward.
And I think another element here, one of the principles that we talk about is stability. And one of the things that undermines stability is political uncertainty. And President Trump mentioned in his recent address to Congress that he was interested in just repealing these provisions. So the effects that Garrett is talking about are going to be even harder to identify if businesses are rethinking their strategy of investment given the political uncertainty. And I'll mention as well that the Chips and Science Act was a bipartisan exercise, and that is something that makes me wonder, like, what's the future of this relative to things that were strictly partisan, including what we were talking about earlier with the Inflation Reduction Act. It's not really clear what the future of this policy is, and I don't know what the Trump administration will be doing, either undercut or undermine the Chips and Science Act on their own. But I think it's important to point out that there was bipartisan support of that initiative.
Yeah, and we had done a podcast probably around a year ago right now with the tax policy analyst here at the Tax Foundation, Alex Merjano. And something him and I discussed on that was actually like, well, something might not always be good economically, but as Garrett pointed out, yeah, there it might not be good to rely on China for our semiconductors. If this is an important part of technology and an important part of America being maybe a little bit more independent and safe and maybe a national security issue, that there's good tax policy. There's all of these things we can talk about, but maybe some things, even if it's a net negative, can still be like, okay, we just need to bring this home somehow for a national security purpose. And that's just a really complicated part of this.
You don't just want to like have like tunnel vision on, okay, well, this single tax credit is going to take care of it. One of the things we talked about was, okay, let's say we do accept the premise we need more semiconductor manufacturing here. Then what should the policy response look like? Well, look at the cost recovery system we have right now. If you want to create a fab in the United States, that's like a huge investment, like $1 billion plus just to create the facility. How does the tax code treat that? You have to depreciate a commercial structure over 39 years. So if we provided better cost recovery for structures, what's the cost of like the actual machinery, the lithography, all these different things you have to put in the building? Those are like millions of dollars, hundreds of millions of dollars in some cases for the most advanced technology. How do we treat that? Oh, well, bonus depreciation is phasing out. How do we treat research and development? Oh, you have to amortize that. So we've got all of these just baseline policies that are biased against that investment in the first place. That's before we even like wade outside the tax policy world and look at the regulatory environment, look at the labor force, look at education and training. So even if you do want to, boost one certain sector, this, really narrow industrial policy focus probably isn't the right answer anyway. So speaking about structures of tax systems, let's look at what the states are doing. There have been more and more states moving toward having a flat tax in recent years. So what's that trend about, and what are the economic and policy implications of that?
So our state team has been watching very closely the trends in the states and engaging actively in the last, 5, 10 plus years, just seeing how things have evolved in the states. And it's a very dynamic time, right? When you have 50 states and of course, ever more localities experimenting in tax policy, trying different things out. And that dynamism really increased even more so, turbocharged during and after the pandemic, where we saw states, of course, with at the time very uncertain and unstable budget prospects, then coming into a lot of cash, both in the economic recovery and some of the federal spending that came to them. And that led states to make a decision on what the long-term structure of their tax systems should be. This all comes at the same time as we're seeing a lot of increased migration and decision points by people long-term of where do I want to live? What's the business and tax climate of the states and localities that people and their families live in? And that led to a lot, of course, as we know, a record number of migration. And that's, I think, led to a lot of states, stepping back and deciding it really makes sense to have a competitive tax code, particularly on the individual income tax side, that's simpler and invites people and businesses to move to those states. And that's what we've seen as a result. What we've seen from just from July 21 to January of 25, in those 3.5 years, 6 states enacted and fully implemented a single rate individual income tax system, which sort of broke from the trend in the past where we didn't see many states going forward with that. And I think the difference is, especially from some of the experiments in the past, was in most of these cases, states are doing this in a prudent way, trying to, and that's something that we've been really emphasizing in our state team's work, which is making sure that states are doing this, moving and reforming their individual income tax systems in a way that's sustainable, that ensures that they can hit their budget goals, but also makes their tax code simpler and more competitive. And so one tool that's been used pretty effectively to date and will continue to be used, of course, is looking at phase downs and tax triggers, tying certain changes in the individual income tax rates and structure to a given amount of revenue. That's really helpful to ensure that there's adequate revenue there and stability. And that has led to, in many states, not just since 21, but even in the half decade prior to that, can start phasing down their rates even in states where there's not a flat individual income tax. And so that's really, turbocharge some of the increased competition across states because it does feed on itself, right? If there are states that are moving toward a flat income tax or even talking about eliminating their income tax, that other states take note. And I think they're more sensitive now because they see the power of this migration, the importance that people place on a competitive and stable business and tax climate. And so what that means is, this trend is unlikely to be stopping, right? It may slow down, it may change as time goes on, but this will continue. Of course, we're also watching, other trends in state tax as well, right? Emerging and continuing discussion about the structure of property taxes at the state and local level. That's really important to be engaging on, as well as, of course, efforts to go even further and move from a flat income tax to eliminating it. There are several states that are looking at that. And so we'll continue to do that and provide guidance to state policymakers.
Yeah, and I think another important point here is just the geographic diversity of this approach. Like right now, there are states in the South, in the Mountain West, in the Midwest, in the Mid Atlantic that all have flat income tax structures. Some of the states that have moved in that direction are kind of across the country. So it's not just one portion of the country that's really moving in this direction, but like Garrett said, this is a widespread trend that we've seen. And to his last point, like there a lot of what we're seeing and a lot of what we're researching and exploring with different policymakers and in different states is if there is a political movement to reduce or lower income taxes or bring in flat taxes, that it's done in a fiscally responsible way. The worst thing that a state can do kind of with any policy approach is to blow a big hole in its revenue budget. States have to balance their budgets. They have much tighter fiscal constraints than the federal government. And that means that if they make a mistake with either cutting taxes or especially on things that might be a major part of their revenue system, they would have to make up the money elsewhere. And no politician wants to cut taxes one day and have to raise them the next.
And yeah, and I think I'll leave one Easter egg here for some of our listeners is that particularly on property taxes that Garrett mentioned is, I didn't know this, property taxes can affect renters like me. So if you want to go listen to our property tax episode and learn all about that, if you go listen to our episode with the excellent Manish Bhatt, who broke all of this down, everything you want to know about property taxes, I think it was a really, really fascinating episode, and property taxes affect a renter like me. So that I think that was so interesting, and it was a really good episode if you really want to understand what's going on with all of this. But we're going to transition here since we've been talking about a lot of different things, and we're going to talk about federal, and we're going to talk about TCJA, which is something Erica and I are very familiar with at this point. So Erica, looking ahead, we know the TCJA is a big deal, and we don't know exactly what's going to happen with all of it this year. What do you see happening? What's going to go down the line? How is this all going to play out politically?
Yeah, so we kind of have two buckets of tax policy. One, the expirations. So there are individual income tax cuts expiring. There's an estate tax cut expiring. There's business tax cuts phasing out or that have already switched. And so Congress is considering, let's just extend those expirations, maybe with some changes here and there, but for the most part, let's just keep doing what we did back in 2017. The other bucket is full of all of the campaign promises that Trump made on the campaign trail. So adding different types of tax cuts like no tax on tips, no tax on overtime, no tax on Social Security, deductibility of auto loan interest, potentially a corporate tax cut or something for manufacturers. Those are the bulk of the ideas. So together, those two buckets add up to more than like $7 trillion of tax cuts, which is a big number, especially when deficits over the period are already going to exceed like 20 trillion. And so then the question for lawmakers becomes, what do we prioritize? Do we leave anything off the table? Do we consider base broadeners or other ways to offset the tax cuts on the tax side of things? Do we also add in some spending cuts to offset this impact on deficits? And that's what Congress is working through right now. The House has passed a budget resolution that would allow an increase in the deficit of $4.5 trillion from tax cuts, combined with about $1.7 trillion in spending cuts to offset part, but not all of that. The Senate is now working on its own version, and we don't know what their numbers are going to look like. Maybe they'll have more spending cuts. Maybe they won't. Maybe they'll allow more deficit increase from taxes. Maybe they won't. It's a question mark. And then once we see what the Senate's going to want to do, the House and the Senate have to work on that together and come up with the final number. And that's not the end of the story either. Once they set the final number, then they have to figure out, okay, which from each of these buckets can we fit into this number, and how do we do it? So a lot of moving pieces and a lot of questions. But what's at stake is that if Congress does nothing and all of this expires, 62% of American taxpayers would see their taxes go up starting in next year. I don't think there's really any member of Congress who wants their constituents to see a tax hike like that. So we'll probably get some type of tax bill this year. We just don't have really any idea what it's going to look like yet.
The other major aspect that will be following along in addition to the TCJA debate related to it, of course, is what Congress does with the litany of additional potential tax cuts that President Trump ran on a pretty aggressive agenda of trying to exempt all different types of income from income tax, notably trying to exempt tips from income tax, overtime pay, Social Security benefits, potentially creating a new deduction for auto loan interest that folks pay, maybe looking at some expansions to childcare. There's all sorts of various ideas here that the White House has been pretty clear they want to see in this package. And of course, that adds to a couple of different things on Congress's plate, right? One is, of course, adding to this already complicated and difficult budget math, because these are tax cuts that will either increase the deficit or require an offset. And the second, of course, is making the detailed design decisions in the legislation of how exactly would an exemption for overtime pay work. How are we going to define overtime pay? How are you going to create various guardrails, for example, to ensure that people don't turn their pay into a tax exempt tip, for example? All of those things require work and effort by offices and leadership to get into legislation, and so that just adds to the challenge for Congress this year. But of course, taxpayers are watching closely especially because many of them may view the extending the current tax cuts as a continuation of the status quo and the avoidance of a tax hike they may not want. But they may want tax cuts in addition to that, right? There's some interest in that, and so that these additional sweeteners will be part of that discussion. One big question is, to what extent do they try to make those additional tax cuts permanent, or do they make them temporary as part of the budget math? And we'll be watching that closely.
And I would add this. I think if I was to try to, circle back and bring this full circle with the Chips and Science Act and IRA, and then looking at TCJA, is these are different ways of adding complexity. Like, we had one version of complexity, which is, green tax credits and business complexity. And now we're adding complexity to the individual income tax code in different ways.
Absolutely. This is one of the things that we think about a lot. We generally support fiscally responsible lower taxes, but there's different ways to achieve that goal, and by creating all sorts of carve outs for specific populations or type of taxpayers, you're just making the whole system worse. When really, the old mantra of broaden the base and lower the rates is the right answer here. You don't necessarily want to carve off parts of your tax base and give tax cuts to a few. You want to be, policymakers should want, they don't always want, they rarely want, in fact, they should want to have a simpler system overall with a broad tax base and generally lower rates.
And so we're going to switch gears and we're going to move over to tariffs now, which is
an even broader base.
An even broader base. We're gonna, the never-ending abyss of changes. We have a wonderful tariff tracker we're updating constantly because things are moving and shaking and changing constantly. And so, Erica, how have tariffs shaped economic policy, and maybe how have they changed your life personally, since you have to deal with this all the time?
Yeah. So while Congress is considering major tax cuts, the president is considering major tax increases, which, because Congress has delegated its authorities to do tariff policy to the president, the president has quite a bit of leeway and pushes those authorities to probably go beyond what's really allowed. So, in the first Trump administration, we saw this to some extent. Congress enacted the Tax Cuts and Jobs Act. President Trump started a trade war with China. That offset some, but a fairly limited portion of the growth that we expected from the tax cuts, because the trade war then was pretty much contained to China and covered, about half of what we imported from China. So in terms of like how big would its effect be on the entire huge US economy, pretty small. Now what we're looking at is potentially tariffs on every single trading partner. So rather than just limited to China and the strategic competition we face with them, tariffs on, friend and competitor alike. So this is a really big shift from decades of U.S. policy, where the goal was generally let's increase market access and let's lower barriers to trade. So businesses and people are free to specialize in and do what they do best. Uh, Now we're saying the government's really going to intervene across the board and block imports, and then try to block imports of certain products too, from semiconductors to steel to aluminum to copper to lumber to autos. We're expecting higher tariffs on all of these specific products, plus higher tariffs across the board. So we've been tracking it at Tax Foundation. We've got our tariff tracker. We've updated it more than a dozen times so far this year. I've got a doc opened right now of another update. We're going to be updating again next week. And the chaotic and rapid pace of tariff announcements itself has been unprecedented. Um, the effects we've estimated right now kind of should give people pause about what's happening here. Just the tariffs on Canada, Mexico, China, steel, and aluminum are economically harmful enough to offset all of the output boost, the growth boost that we expect from the individual income tax cut. And that's before we factor in how our trading partner is going to retaliate. So I think that's moving economic policy in the wrong direction. It's potentially going to offset all the benefits that we would expect to see from tax reform, and it will significantly increase the tax burden on lower and middle income households, potentially even if we get new and more tax cuts. They could be worse off given how burdensome the tariffs are looking to be.
And I have two quick thoughts that I'd love to get everyone's opinion on, or just, some more thoughts on. One, I finally reached the age where I talk about the stock market with my friends. Um, and so we were talking about that, and we're all just sitting there realizing that tariffs are actually affecting our lives, even whether they've been implemented or not, because we don't know whether to invest in something or not. I have a little bit of money that I can invest, and I'm like, I don't know if I should put this in XYZ. And everyone's like, I don't know, just wait, just put it in a high yield savings account. Like, you're in this place where you're just like, it affects people even if it hasn't been implemented, because we don't know what's going to happen. And then the second thing I'll say is I think we have this we can have a very macro view on tariffs. But I was talking to my brother-in-law who owns a construction business, and every single estimate he hands people now is with the caveat of this price could go up because of tariffs. And he doesn't know. And so when he hands people, he can't be as accurate or as precise as he would like to be. And that does affect his life, and it does affect his business and what he can do. And that's just, I think that can just get lost in all of this talk, but it affects real people's lives at the end of the day.
Absolutely. The example you gave of I don't personally know where to put my money right now. Like every person and every business is facing that same question. And a lot of times what businesses are going to do is just sit on their hands. Like maybe they had an investment planned. Maybe they were going to, engage in a new business partnership with a business in Mexico. Maybe they were engaging in trade with someone in Canada, and they had set up their supply chains to rely on inputs from Canada or Mexico, and then they export that thing back to that country after they, make it here with those inputs. Right now, you're not going to want to expand your business. You're not going to want to engage in some type of new partnership, sign a contract or something, because you have no idea if that's going to make sense in a couple of weeks. If you now face a 25% tax on that purchase, probably not worth it anymore. So even if the tariffs aren't in effect yet, they have an economic cost because of that uncertainty, because of the toughness of making decisions. And then I think your point on the stock market is like perfect too. What is the stock market? It's the expectation of like future profits. It's how profitable do businesses think they are going to be. We've got some, and we're going back to macro now instead of micro examples, but we've got a bunch of research from the first trade war that said Like, what happened to the businesses who saw their stock values decline on days of tariff announcements? And significant drops in employment and profitability and sales and revenues. Um, so it's telling us like the stock market is saying these are bad for the US economy. If these stay in place, or even if we're in a period of higher uncertainty for a long time, we expect our revenues to go down, our sales to go down, our profits to go down. We won't be able to hire as much. And so, yeah, this is really just bad across the board.
Just kind of one quick thing to that, which is I think compounding the uncertainty from a policy perspective is just how striking it is, the sheer incoherence of what the goals are, or the unclarity, the lack of clarity and the tension of what the goals are for this makes it really hard for businesses and taxpayers and policymakers not involved to know when are these tariffs coming down? What is victory here? We just don't know, right? There's a variety of things that have been pointed to on what the goal is, right? Ranging from national security concerns to manufacturing to ensuring that we get a better deal from allies and partners. And so knowing what the sort of end result is really important. So at least folks know where are the tariffs going, when may they come down. Because if we just don't know that, that adds a whole nother layer of uncertainty about what our trade policy is moving forward. So that's also really important.
I had a conversation with some people from Europe this week, and they said, we don't really know what's going on with the tariffs. Why is President Trump imposing them? I said, I don't know either, and no one knows. And like that's the big question. Are they here just to negotiate a better deal? Or are they here to like be a permanent revenue raiser? Those are two very different things and have very different implications. And depending on, who in the administration you hear talk, or, who they're speaking to, you hear both of those as strategies, and it's impossible to do both. You have to choose one. At this point, we don't know. Like, we don't know what path they're walking down yet.
Yeah, and I think that speaks to kind of a theme of this conversation. We didn't plan this out ahead of time, but really, it's about complexity and uncertainty. And this is one of the things that we consistently see policymakers like taking steps down this road, and we say it's not going to work out well, and sometimes it's as dramatic as starting a trade war. And that is going to be something that's U.S. economy is going to have to bear, regardless of what the ultimate policy decision is, because of the uncertainty and the complex environment and the decisions that these businesses or private actors are having to adjust in light of the potential tariff.
Which is very unfortunate. But I want to say I appreciate all of you guys being on the show today. This is a great way to talk about the biggest tax stories going on. I think the listeners are going to really like this and appreciate this. And just thank you guys for being on the show today. Daniel, Garrett, and Erica, you're always here. So thank you for being here still.
Thanks so much, Kyle.
Yeah.
Thank you, Kyle.
And all right. So before we sign off, I'm just going to say, if you have any burning questions on taxes, you can send them our way. You can drop a comment on YouTube. You can DM us on Twitter. You can email us at podcast@taxfoundation.org, or you can slide into the DMs, like I said. Thank you for listening.